Today, we're going to discuss 3 critical elements of the cash flow statement. So if you've been in business for years or you're just starting your entrepreneurial journey, this video is for you. The cash flow statement is a crucial financial statement that provides insights into how cash is generated and used by the business over a specific period of time. It's divided into 3 main categories: operating activities, investing, and financing activities. Let's discuss each section and explore how you, as a small business owner, can use this statement to gain a clear picture of your business's financial status and take actionable steps. Operating activities involve the core business operations that generate revenue. So this section captures cash transactions related to sales, expenses, and other day-to-day operational activity. Cash inflows from customers, cash outflows for operating expenses such as rent, utilities, and wages, and cash outflows for taxes and interest. So a positive operating cash flow indicates that your business is generating enough cash from its core operations to cover day-to-day expenses. You always want to focus on improving sales and optimizing operational efficiency and managing expenses to maintain positive operating cash flow. A negative operating cash flow may suggest a need to review and adjust operational efficiency, pricing strategies, or working capital management. You will want to analyze every aspect of your operating cash flow to identify areas for improvement. So consider renegotiating payment terms with suppliers and adjusting your strategies. Investing activities involve cash transactions for the acquisition or sale of long-term assets such as property and equipment or investments. A positive investing cash flow may indicate that your business is making strategic investments in assets or business ventures. So consistently assess whether these investments align with your long-term business goals and consider the potential returns and impacts on future cash flows. Now, a negative investing cash flow could suggest a reduction in capital expenditures or a reduction in another form of income. In scenarios like these, carefully evaluate the need for large capital expenditures. If possible, explore alternative financing options or consider delaying non-essential investments until your cash flow is better. Financing activities involve cash transactions related to the business's capital structure, such as debt and equity. So cash inflows from loans, cash outflows for debt repayment, or cash transactions with owners like dividends. A positive financing cash flow indicates that your business is raising funds through external sources and generating cash from equity transactions. So consider whether additional financing is needed for the growth and operational needs, and evaluate the terms of debt and explore options for optimizing your capital structure. A negative financing cash flow may result from repaying debt or returning capital to owners. So evaluate the reasons for the negative financing cash flow, and if it's due to debt repayment, assess the impact of liquidity and plan for alternative sources if needed. The net cash flow is the sum of the cash flows from operating, investing, and financing activities, and it represents the overall change in a business's cash position. So regularly monitor the net cash flow to gauge your overall health of your business's cash position. Positive net cash flow is generally favorable, while negative net cash flow may require a little attention. Maintaining adequate cash reserves is crucial for handling unexpected expenses or periods of reduced cash flow. So ensure that your business has sufficient cash reserves to cover short-term obligations and unforeseen challenges. Suppose your small retail business experiences a period of slow sales. Examining the cash flow statement may reveal a negative operating cash flow due to reduced cash inflows from customers. In response, you might implement strategies to enhance sales, such as promotions or discounts, or closely managing operating expenses. Additionally, you may defer non-essential investments and explore options for short-term financing to improve liquidity. But by regularly reviewing your cash flow statement and taking proactive measures based on the insights gained, a small business owner can navigate these challenges, optimize the cash flow, and position your business for long-term success. Hence, another reason to make sure that you have an accountant, bookkeeper, or another financial professional on your team to help with this process. Now, if you found this video helpful, hit that subscribe button, give it a thumbs up, and drop any questions you have in the comments below. Until next time, stay financially savvy, and thanks for tuning in to Tried and True Financial Services, where our core mission is to empower entrepreneurs by providing them with the knowledge and strategies to gain better control over your finances while upholding the highest standards of ethics and integrity.